This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, here in Chapter 12, we now move away from the taxability of income. Look at the taxability of chargeable gains. Now, the concept of a chargeable gain is a very simple one. That is that I sell an asset for more than the costs that I've incurred in acquiring or indeed selling that asset. My net proceeds exceed all of my other allowable costs. So basically, I buy an asset for £20,000, I sell it for £30,000, I make a gain of £10,000. So it's a very simple concept. Very simple, that is, for individuals. Slightly more interesting, dare I say, so far as companies are concerned, because as we'll see here in our first note, what we have is that individuals, you or I, we pay capital gains tax, or CGT, as we'll know it from now on. And we pay that on our chargeable gains, to be precise, on our net gains of the tax year. Just because we own, as we'll see, and call it a chargeable asset, does not mean to say that at the point of disposal I'll actually be able to sell it for more than cost. I may indeed incur a loss. So individuals pay CGT on their chargeable gains, their net gains of the year. And that's what we'll be dealing with over the next 3 chapters here. Companies, however, do not pay capital gains tax. Companies pay corporation tax on their so-called taxable total profits. We'll see that when we get introduced to corporate tax in Chapter 16. Companies pay corporation tax on their taxable total profits. And the taxable total profit of a company is made up of 2 components, both their chargeable, their taxable income, but also their taxable gains. And the way that gains are computed so far as a company is concerned, and the way then that they are taxed, is somewhat different to individuals. So, individuals, as we'll be seeing in these next few chapters, pay CGT on their taxable gains of the tax year. Companies will include their separately computed chargeable gains upon their corporation tax computation, and as a part of their overall taxable total profit, it will be subjected to corporation tax. Now, whether you're dealing with an individual or whether you're dealing with a company, the same basic definition in terms of, so when does a gain arise, exists. A chargeable gain will arise, or an allowable loss will arise or be sustained on. Now, here's our important terminology. On a chargeable disposal of a chargeable asset by a chargeable person. Now, the last bit there, a chargeable person, is basically someone resident in the UK. And for our purposes, that will always be the case. At F6, you'll be dealing with a UK resident. So the 2 terms that we need to focus on are these terms chargeable disposal and chargeable asset. And you'll see those terms defined and given examples of just below. As we said, the basic calculation of the gain that goes into this calculation is a simple one, deducting all the allowable costs of an asset away from its net proceeds. As we said, a company, not an individual, will of course pay corporation tax upon their gains, but they get the ability to reduce their gains by one further factor, for the effects of inflation. When I said to you a few minutes ago that an individual buys an asset for £20,000 and sells it for £30,000, there is a chargeable gain of £10,000. But that pays no attention to the time difference between when it was bought and when it was sold. So I might have bought an asset in the year 2000 and I sell it now in the year 2017, and I am simply comparing today's proceeds with yesterday's, the year 2000's cost, and I'm paying no attention to the fact that inflation will have taken place, such that £20,000 cost incurred back in the year 2000 might be equivalent to £25,000 in today's terms. Now, when dealing with individuals and CGT, inflation, the effects of, doesn't come into it. It literally is that straight comparison of proceeds with cost. So that might not sound overly fair, but it does make life a whole lot easier for us in computing the gains. When it comes to dealing with corporate tax and capital gains for companies, as we'll see in later chapters, then we are able to give relief for the effects of inflation. Now, how we measure that and how we compute and deduct our so-called indexation allowance. It's an index that is used to measure inflation. It is, in fact, the Retail Prices Index, RPI, as those of you who live in the UK will recognise that term, no doubt. But again, we'll see how we compute that. So, companies get indexation allowance to give relief for the effects of inflation. Individuals do not. Now, before you start saying, that's not fair, remember, the F word, fair, has got little to do with taxation. But individuals do get, as we'll see very soon, the equivalent to what they get on income tax, which was a personal allowance, but in terms of capital gains tax, it's called an annual exempt amount, AEA, again, as we will know it from now on, an annual exempt amount. Companies don't get that. Companies, if they make £1 of a gain, will be chargeable to corporate tax thereon. Not so with individuals. So we got good news and bad news separately for both individuals and for companies there. So far as any gains are concerned, most specifically when made by individuals, there's a range of various reliefs that may be available to mitigate that gain. So here, what we call qualifying gains, only certain assets, surprisingly, qualifying assets, will be eligible for these certain reliefs. Now, those reliefs will apply in either of two main ways. They will allow such gains or parts thereof to either be exempted, now that's as good as it gets, you are exempted that gain, and on that basis there is never a chargeability. However, most of the reliefs that we will see are not exemptions, but they're deferrals. So they would defer gains from immediate chargeability to tax. So that means that what would have been taxed today, this tax year, is instead going to be taxed at some future point. Now, again, if you've got a choice between being taxed on a gain now, or maybe in 2, 4, 10 or 20 years' time, then it would make sense, no doubt, on that basis to defer those gains. Clearly, it's not as good as being able to exempt a gain, so it's not taxable now, nor will it ever be taxable. Well, we will see those reliefs later in chapter 14, indeed, when we have worked through the basis of calculating gains and losses and the basis of working out the CGT liability thereon. We'll then look at those reliefs. One of the more complex, one of the more detailed areas, an area indeed that will stay with you for those of you who are looking forward to going on to P6 and advanced taxation. They'll be as important there as they are here. Right. Chargeable disposal of a chargeable asset by a chargeable person. Chargeable disposal. Now, when you think about how an individual would chargeably dispose of an asset, we're thinking probably about just one thing. How do you chargeably dispose of an asset? Well, you sell it, of course, there. You sell it. But it's not the only way by which a chargeable disposal may occur, and those other occurrences are common so far as our exam questions are concerned. So as we've said, it's usually the fact that we sell an asset. But again, a chargeable disposal will also arise, surprisingly, when an asset is gifted, or indeed whenever it's lost or destroyed. Now, there is no chargeable disposal upon the death of the taxpayer. You may be considering that the only time that a taxpayer would give away their assets is when they have no choice, when they die and they're distributed according to the terms of the will there of the individual. But no chargeable disposal occurs on the death of the taxpayer. So when we talk about gifts and a chargeable disposal, we'll be talking about gifts made in lifetime there. Now we might think, well, that's it then. I've got the perfect advice for my client. The brilliant way by which we can avoid CGT. All you've got to do is die. Give it all away and there'll be no CGT. Now, sadly, there are a couple of downsides to that plan. The obvious one is you're dead. The other one, a technical one, is that although assets will be free of CGT, those assets will then pass free of CGT to the beneficiaries at what is still good news, at their market value, otherwise known as probate value. I'll come back to that in a moment. But the sad part about this is that although there is no CGT on death, we will see chargeability to inheritance tax. Yes, that other, and we'd probably say final, personal tax that we have to deal with here, inheritance tax. That may arise when we die. And for that, well, we'll see, again, a very large chapter, chapter 24, that deals with the entirety of what we need to know for inheritance tax. So, in lifetime, a chargeable disposal will usually occur when we sell an asset. We will therefore use the sales proceeds going into our capital gains calculation. But of course, as we have just said, if you give away an asset in lifetime, it is a lifetime gift, that is still a chargeable disposal, and assuming that the asset in question is a chargeable asset, we'll look at that next, assuming it is a chargeable asset, then there is a gain to be computed. Now, of course, we're thinking, if you give it away, there are no sales proceeds. That is why, as we've said, assets will be transferred at their market value. If you give an asset away in lifetime, you, for purposes of CGT, in calculating the gain, will use the open market value. Now, that open market value serves two purposes. It forms the basis for computing the gain for the donor, the vendor, the person disposing of that asset. We use market value instead of sales proceeds, but that market value will then also become the base cost so far as the beneficiaries, the donee, the recipient of that particular gift is concerned. If, using the word there, beneficiary, if the disposal does indeed occur on death, then although the individual, the beneficiary, acquires at market value, there will of course be no CGT so far as the deceased's estate is concerned. No CGT on death. As we said, we know why. They give away with the one hand and they take with the other, because although there is no CGT, we have inheritance tax. So, chargeable disposals that you will commonly see in exam questions, the most common, we simply sell it. Quite often we see gifts of assets. We need the market value of the asset to compute the gain or loss that may then arise. If it's a gift on death, there is no CGT. Equally, we would need to be able to deal with a circumstance where the taxpayer may lose an asset or it is destroyed. In those cases, the outcome will be dependent upon whether or not the asset in question was insured and there were proceeds that arose out of its loss or destruction. Were there any proceeds? And a further issue, what do you then do with those proceeds? Do you just pocket them, which will give rise to a gain, or do you use those proceeds and reinvest in buying a replacement asset to the one destroyed or lost? More of that later. So, chargeable disposal of a chargeable asset. We've got a fabulous definition of a chargeable asset. That is, all assets are chargeable unless they are specifically exempted. Now, the typical exempt assets that we see and that you need to be aware of. Firstly, motor vehicles. They're that are suitable for private use. Normally a motor car, but motor vehicles suitable for private use. If you dispose of your car, then it is an exempt disposal. And that will apply whether it's what you're thinking of, just your car that you use on a day-to-day basis, or even indeed if it was an investment asset like a vintage car. Cars, whether vintage or otherwise, are exempt from CGT. Now again, in most circumstances, 99.999% of circumstances, when an individual disposes of their motor vehicle, they do not dispose of it for more than cost. You or I selling the car that we've driven around in for a year, 2, 3, or however many years, will inevitably be selling that car for significantly less than we paid for it. And hence you see the reason why motor vehicles are on this list of exempt assets. It is not designed here to do us, the taxpayer, any favours. It's designed to do HMRC a favour. Because if they were chargeable assets and millions of taxpayers each tax year sold their motor vehicles at a loss, then each of those millions of the taxpayers would have an allowable loss that they could set off against capital gains if there weren't any this year, then carried forward to the future. It's going to do the HMRC no good at all to allow us as taxpayers losses that we'll only then set off against gains. So there's often method in the madness of the examiners here, of the HMRC here, in as much as what we get as exempt assets is often because those assets, when disposed of, would not give rise to gains, but would be more likely to give rise to losses there. So motor vehicles. Other exemptions from income tax that you'd be familiar with, national savings and investment certificates there. Again, we have an exemption both from income tax and also indeed there from capital gains tax. Investments held in an ISA, again one that we'll be familiar with from income tax. Other stuff that is exempt here, government securities, otherwise known as gilt-edged securities, qualifying corporate bonds, corporate loan stock there. Those too are exempt. Probably one of the most important areas of exemption when it comes to CGT and the calculations that you need to do is dealing with certain, there's a lovely old-fashioned word, chattels, defined as tangible, movable property. Tangible, movable property. Things like antiques, paintings or other works of art, items of jewellery there. Tangible, movable property. This obviously excludes motor vehicles that we've already made mention of. These chattels, certain chattels, will be exempt, or possibly a limit may be applied to any gain or indeed any loss that arose, depending on how much it was sold for and how much was the original cost. So there's some useful and interesting stuff to be seen on chattels. Various other ones that are indeed exempt, foreign currency for private use. Yeah, you bought some dollars or euros or whatever to go away on holiday. You've got some spare when you come back, though that's probably not very likely. You've got some spare when you come back, and you take them back to the bank and you exchange them back for sterling, only to discover that the exchange rate has changed and you now get more sterling back than was your cost. You make not really much but a small gain. That gain or loss is going to be exempt. Decorations awarded for bravery. Now that's where they've been awarded for bravery. It's not that you are a collector of such things. You walk into an antique shop, no doubt under enemy fire, and you bravely purchase this medal, and again you retreat under enemy fire, and eventually at some point in time you sell that. That is not going to be an exempt asset there. That's an investment you bought and you have sold. No. Decorations awarded for bravery. Those are the ones that we're dealing with that are exempt. Damages for personal injury, life insurance policies, works of art given for national use. Again, if you give them over to the state for national use, surprisingly, they won't charge you to CGT thereon. Much the most likely ones, however, that we see here, that first one, which is just an absolute exemption, and also then these various chattels. These are the really important ones that come up on a very regular basis. More of those chattels later, but certainly motor cars, motor vehicles for private use are just exempt, end of story. If you use other text, what you might see listed here is also another, the most likely asset that a taxpayer will ever have in their life, and that is their main residence, the property in which they live. It's not actually an exempt asset. Your principal private residence, as it's known, is not an exempt asset. But as we'll see in Chapter 14, for the vast majority of taxpayers who buy their house, they live in their house, and eventually at some point they sell and they make a capital gain. It is effectively exempted because of a relief known as principal private residence relief. Principal private residence, PPR, relief there, which, as I've said, in most circumstances will effectively exempt all of that gain because the relief will be 100% of the gain. But they are not technically exempt assets. And indeed, there are situations that will arise, as we'll see in Chapter 14, where when you sell your property that you have it lived in for some, but maybe not all of the time, as your main residence, when you sell it, it is possible that some of the gain arising, some of it will indeed still be chargeable to CGT. So I've not listed that here, but we'll see it in Chapter 14 under PPR relief. Those are the two main terms, chargeable disposal and chargeable asset. Chargeable person, again, basically someone resident in the UK, is liable on their worldwide assets. And that's as much as you need to know so far as F6 is concerned. Okay, moving on. How do we calculate individual gains and the amount of gains that are subject to tax, the taxable gains, and how do we then tax those taxable gains? Well, as we've already mentioned, but let's remind ourselves of it here, the basic calculation of a gain or loss is a very simple one. We want our disposal proceeds, our disposal consideration. Yeah, 99% of times, no doubt, it is in real life sales proceeds. But remember, if an asset has been gifted and it is a chargeable asset, then a gain is still to be computed based on market value. So open market value there may be used. Less any incidental costs of disposal, selling expenses. If you are selling a property that is not your principal private residence, attracting 100% principal private residence relief, think what costs you may incur when it is sold and when a gain must be computed thereon. You've no doubt used an agent to achieve the sale. There will be an agent's commission to pay. There will be legal expenses incurred in dealing with the sale of that property, so those legal expenses. If it's a chattel, a work of art, an item of jewellery, an antique, it goes into an auction maybe for sale, and there are auctioneer's fees, expenses that need to be paid. All of these are perfectly legitimate and allowable costs of disposal, selling expenses. They get deducted in deriving this net proceeds figure, away from which all of your allowable costs must then be deducted. Now, normally it's a simple one. You bought an asset for £20,000, you sell it for £30,000, there's your £10,000 gain. Your cost is what you paid for it. But of course, in exam questions, there will be some more interesting scenarios, such as we didn't actually buy the asset. As we mentioned earlier, it was gifted to us. And whether it was gifted to us then in lifetime or indeed on death, for me, the beneficiary, the donee, the person acquiring that asset as a result of the gift of another taxpayer, that will come to me at market value. So my cost, if I acquired it as a result of a gift, will be the open market value. But however I acquired it and have therefore determined its original cost, during my period of ownership, I may enhance or improve that asset. There are extra enhancement expenditure costs that I incur. I buy a property and I then put on a conservatory, an extension, a garage. All of that incurs capital costs, which upon sale will be allowable deductions, unlike repairs or maintenance costs that are revenue expenses, as we saw when looking at the adjustment of trading profits in Chapter 4, and revenue expenses are not deducted here in deriving a capital gain. So, having established the disposal consideration, the disposal proceeds, taken out any and all allowable selling expenses, computed then all of the allowable costs to offset against the net proceeds, I derive my capital gain or loss so far as that individual asset is concerned. Now then, so far as you or I are concerned as individuals, that's it. That is the gain or the loss for, as we'll see in a moment, the tax year, same as income tax, the tax year, 6th of April to 5th of April. I will record and net out those gains and losses of the year before then attempting to compute the taxable gain and proceeding to calculate the CGT liability. So there is my basic calculation for disposals in the tax year for gains or losses. Now, as I've said, once I have computed those individual gains, I then got to work out, like we did in income tax, a taxable income. I now have to work out a taxable gain. And having got the taxable gain, then I need to work out the CGT liability thereon. So, the first off, the capital gains in the year, the capital losses in the year. So I get the net gains of the year. It is possible that in an earlier year, the only transactions or the net outcome of different transactions was a net loss that has been brought forward, it's unused coming forward into this year. Now, from the net gains of this year, I deduct any capital losses brought forward. That will give me the net gains, but it's not the taxable gain, because away from those net gains, I can then deduct my AEA, my annual exempt amount, my annual exempt amount. Now, that information is provided on your rates and allowances page, though again, I think much like with the personal allowance, by the time you come to the real exam, you'll know it very well by then. But it's given. If you have that memory block in the exam room, it's on your rates and allowances page. And that gives you your taxable gains. And having got those taxable gains, it's then a question of charging them to tax. And a little bit at least like we have the situation in income tax, there are different rates that may apply. We could be seeing 10%, 20%, 18%, or 28%. As we'll see in a moment, the precise percentage or percentages that you have to apply will depend on various things. Firstly, in terms of the gains that you have made, the type of asset upon which the gain has been made, because certain assets will attract either lower or higher rates there. And having looked at the type of asset that will lead to its eventual tax rate, we also have to make a reference to our income tax computation. Though this is, and I'll keep on repeating this, a totally separate and independent tax calculation. This does not go on the income tax computation. This is a separate CGT computation. But having got those taxable gains, the tax rates that you see here are not just affected by the particular asset that you've disposed of. They're also impacted by whether, from your income tax computation, you are still just a basic rate taxpayer or whether you're a higher rate taxpayer, because that too will impact on whether lower or higher rates of CGT will apply to you. So there's a lot going on, especially now from 2016-17, where there have been some more changes to the tax rates that have occurred that makes these calculations even more interesting, dare I say. Now, once you've established what is the taxable gain for the tax year and the CGT, and you've calculated that. The final administrative issue, but very important in practice, that you'd need to convey to your client, the fact that when do you pay that tax? Well, for 1617, standard single date, you pay the 31st of January following the end of the tax year. So the tax year ended the 5th of April 17, therefore it's the 31st of January 18 when you will pay. Now those gains will be included above, will be after deducting any reliefs. That's actually chapter 14 there. Hopefully by the time you see this I've amended that and it already says chapter 14, but that's chapter 14 where you will see those particular reliefs. Sorry, I've clearly not picked that one up since previous years. A chargeable gain or allowable loss of an individual, as we've said, must be firstly individually computed, as we have seen there. Individuals do not get indexation allowance. That is purely the domain of companies and corporate tax. But as we have just seen, we do get the benefit of an annual exempt amount of £11,100, so far as our tax is concerned this year. Main issue there, as we've seen, is there's a variety of different tax rates that may be applicable. So a lot of the time, as we'll see in section 1.7 beneath here, we'll be given over to working out what tax rates. It may mean that when we do the calculations up here of our gains and our losses, that has to be split out into various analysis columns. You remember how in income tax we split out into the three different types of income for which different tax rates may or would be applicable: non-savings, savings and dividend. And so it is that we'll need to split out where there are gains on assets, where the tax rates will be different because of the asset that you're dealing with. So we'll split out into those categories of asset. Why do we need to do that? You remember again, when you had deductions from income, specifically the personal allowance, we had a set way of deducting that. There we deducted it from non-savings income, before savings income, before your dividend income. What we will be able to do here is to deduct those deductions, the annual exempt amount, your losses indeed, both for the year and if necessary brought forward. We can make those deductions in a way that will mitigate our tax burden, i.e. gains on assets that will otherwise be taxed at a higher rate. We can reduce those gains before we go on and reduce the gains that would be taxed at a lower rate, thus getting the greatest benefit out of our deduction of loss or annual exempt amount. I would much rather reduce a gain that would be taxed at 28% compared to 20%, compared to 18%, compared to 10%. So we're able to apply those losses, the annual exempt amount, in such a way as to reduce the amount of tax that we pay in the most efficient way. Now, all of that information is contained beneath. One final point we'll make again in this lecture, just the points that we've got here before we look at those rates of CGT next time, is about, as you see there, the AEA 11,100 that we as individuals benefit from, but not companies. Other point, just like with a personal allowance, use it or lose it. If it is unused or any part of it is unused, too bad. You get another one next year, but you don't get to carry forward any of this year's that is now unused. Payment of CGT, very simple. There is just one set payment date, the 31st of January following the end of the tax year, and no payments on account apply. Now, when we look at income tax, national insurance contributions, well, certain ones anyway, some of those may be settled by payments on account. Doesn't exist for CGT. There is a set liability, which arises after the end of the tax year is payable the following 31st of January. Right. As ever, I need you at the end of any sessions to go back through what we've done, make sure that you are comfortable with it, before we then move on to what will be the focus of our attention in our next session about these different rates of CGT, the assets to which they are applicable to, and indeed the gains that they are applicable to, depending on whether you were, from your income tax computation, still a basic rate taxpayer or you were already a higher rate taxpayer. Lots to do. The next session indeed will, possibly even more after that, we'll just be looking at the application of these rates of CGT. It's a most important and indeed now more interesting area than ever it was before. So I look forward therefore to taking you through section 1.7 and indeed giving you various examples thereof to illustrate how it is that having computed taxable gains, we then compute the CGT liability of the taxpayer.